Picture this. You wake up, open your investment app, and realize your account balance just jumped more in a single month than you managed to save all year long. You didn't get a sudden promotion, you didn't pick some crazy meme stock, and you definitely didn't pick up a second job. The market simply handed you more cash than your absolute best month of saving ever could, and it did it completely quietly while you were fast asleep. Today we're diving into an explainer on this explosive moment when the market literally takes over and your paycheck quietly stops being the main engine of your wealth. Because honestly, the truth is, once your portfolio hits a specific number, saving more barely matters.
To really wrap our heads around how this works, let's look at two identical savers. We'll call them Maria and Alan. They're both 38, they live in the exact same city, and they both built the exact same sensible portfolio. They started investing back in their late 20s, and for about a decade, their accounts climbed in that painfully slow, unglamorous way that honestly makes you wonder if it's even worth doing it all. But then, right around age 35, when they both hit exactly $400,000 in savings, their life outcomes completely split apart.
So what caused this massive divergence? I mean, it wasn't a sudden gap in their salaries. It wasn't dumb luck, and it certainly wasn't some hot crypto bet. It was literally a single piece of mathematical understanding. Essential mystery that just entirely separated their financial paths. See, Alan figured out a secret about the money he'd already saved, and Maria, well, she completely missed it.
That secret is something called the crossover point. Basically, it's the specific balance where the financial gain changes hands from your hard work to the market itself. Think of it like a relay race. Below this point, your daily grind and your personal savings are doing all the heavy lifting. But above this point, the market takes the baton right out of your hand and it never gives it back.
The math behind finding your own personal crossover is actually almost insultingly simple. Okay, step one, you take what you're able to put in every year. Let's say you're a really solid saver, putting away $12,000 annually. Step two, you just divide that by a reasonable expected return. Historically, a stock-heavy portfolio averages right around 7% over the long haul. So $12,000 divided by 7% lands you at a target of roughly $171,000. And here's the magic. Once your portfolio passes that number, a totally normal market year throws off more than 12 grand all on its own. The market literally just matched your entire year of sacrifice, without you doing a thing.
Now, what if you're an aggressive saver? Let's say you're stacking a 401k, an IRA, grabbing that employer match, maybe doing $30,000 a year in total. Well, your crossover sits a bit higher, around $429,000. But if I had to give you just one specific figure to lock into your memory today, it's this number right here, $400,000. This is the neighborhood where, for a truly committed saver, one ordinary year of market return officially beats one full year of your absolute best savings effort.
And here is where things get absolutely wild, how the growth accelerates from there. Once the market is doing the work, the pile it's working on just keeps getting bigger and bigger. At $400,000, a 7% year is $28,000 of growth. Hit $600,000 and it's $42,000. At $1 million, the market is handing you $70,000 on total autopilot. Just think about that for a second. 70 grand is way more than the absolute maximum you could even legally cram into your retirement accounts. At that point, you're maxed out, skipping vacations, eating ramen savings effort. It's literally just a rounding error compared to what your portfolio is doing on its own. Another fantastic way to visualize this is the rule of 72. It's a neat little math trick. You take 72 divided by your return, and it tells you roughly how many years it takes your money to double. So at a 7% return, your money doubles roughly every 10 years without you lifting a single finger. Jumping back to Alan, at 35, he hits his $400,000. He completely stops adding to it. By 45, it's nearly $800,000. By 55, it's $1.5 million. And by 65, it's $3 million. He doubled and doubled again while he was just out living his life. This brilliantly illustrates a concept that the early retirement crowd likes to call Coast Fire. Honestly, it's essentially the crossover point, just wearing a nicer suit. Coast Fire is the exact amount you need invested today so that, without adding another single dollar, it grows into your full retirement nest egg by age 65. Say you want $1.5 million by 65 and you happen to be 25 right now, you only need $100,000 invested. If you hit that, mathematically, you never have to save for retirement again. You just cover your daily bills and coast. Notice how the target jumps as you get older, though. By 45, you'd need nearly $400,000. You can see the pattern here, right? Handing time the biggest possible head start is literally the entire secret. Think of it this way. A dollar invested at age 25 is doing decades of hard labor for you. A dollar invested at 55 is basically an intern who shows up on the very last day of work and asks where the coffee machine is. Starting early is what lets you reach the crossover while you're still young enough to actually enjoy having reached it. Fun fact,
About 80% of your final balance over a lifetime is pure growth. Only 20% is what you actually saved out of pocket.
Okay, but I have to be honest and put a giant asterisk on this explainer, because we really need a reality check. Everything we just talked about assumes you can actually get to $400,000 in the first place. And well, the median retirement savings for an American household is sitting at about $87,000. Yet you'll constantly hear the average thrown around in the news as $334,000. Why such a massive gap? Because averages are dragged way upward by a few enormous accounts at the top. It's kind of like if Jeff Bezos walks into your local neighborhood bar. Suddenly, on average, everyone in the room is a billionaire. A few giant top-tier balances pull the mean way up, while the typical person in the middle sits way down at 87 grand.
And this is exactly where a lot of financial advice gets, frankly, a bit cruel. Gurus will tell you the median is low because people buy too many lattes or just lack discipline, but we need to empathetically reframe this whole narrative. The reason most people never reach the crossover isn't a willpower problem at all. It's an income problem. Wages simply haven't kept up, and the sheer cost of just existing eats up the margin that used to become savings. You can't divide your contributions by 7% to find your crossover if there's literally nothing left to contribute. So if you feel miles away from these numbers, hear this. You are not failing. You're just playing a game that got quietly rigged. Now there is another major caveat to our math, and it's the one scenario where trusting this crossover number too soon can really wreck you. Averages can lie in the short term. Take the 2000s, a period often called the lost decade. From 2000 to 2009, the S&P 500 delivered an annualized return of roughly -1%. A dollar went in and crawled back out 10 years later as 91 cents. If you hit your crossover in 1999 and decided to just quit saving entirely, yeah, that decade would have completely flattened you. During brutal stretches like that, your active contributions are the only thing keeping the ship afloat.
And there are other real-world risks to keep in mind, too. There's something called sequence of returns risk, which basically means a market crash right when you need the money can gut an otherwise perfectly good portfolio. Then, of course, there's our own human behavior. Firms that track this stuff have found that the average investor badly underperforms simply because they panic sell at the absolute bottom and pile back in at the very top. The market offers a return, but your nervous system basically talks you out of half of it. Combine that with the fact that major Wall Street firms are forecasting future returns well below that historical 7%, and your personal crossover line might be just a bit further away than it looks on paper.
But let's pivot for a second to the roughly 5% of people who do successfully clear the bar, because their fate is actually incredibly strange. Studies show that retirees who entered retirement with $500,000 or more ended up spending down only about 12% of it over 2 entire decades. Actually, scratch that, it's wilder. A third of them actually got richer during retirement. This brings us to a huge psychological trap called one more year syndrome. People hit their number, and instead of feeling freedom, they feel terrified the number needs to be bigger. They literally refuse to believe they've won the game, and they inexplicably keep grinding, trading away their healthiest years just to die rich by accident.
Which brings us right back to the final resolution for our two savers, Maria and Alan. Around age 35, they both crossed the line. The difference? Alan actually noticed. He saw the market was out-earning him, so he eased off. He took trips, he spent time with family, and he just let the machine run. He finished with $3 million. Maria? She never noticed. She kept declining wedding invites to save $300, kept grinding her life away, and kept shoveling in over $700,000 of her own hard-earned money. She finished with $5.3 million. But here's the kicker. Her entire 3-decade grind added less wealth to her pile than the market handed Alan while he was practically asleep at the wheel. She traded 30 irreplaceable years of her life for $2 million extra she will statistically never spend.
Both of them absolutely made it, but only one of them noticed in time to actually enjoy it. The crossover point is very real, but it's a reward, not a starting line. Yes, you have to save relentlessly when you're young to build up that base, but once the machine is big enough, you have to let it take over. Don't be so busy saving for a life that you miss the exact moment you're finally allowed to live it. So I'll leave you with this. Have you run the math to find your own crossover point yet? And honestly, more importantly, when you finally do reach it, will you have the nerve to actually act like it?